Welcome to Felina Management Consultants Academy of Entrepreneurship. The Academy provides online education and training services in accounting and business management to existing and prospective entrepreneurs with the objective of promoting entrepreneurship to achieve sustainable development, especially in Africa. The Academy has facilitators of proven track records in client-focused lecturing, training, and mentorship at affordable rates and friendly after-sales services. Our clients and support teams say the Academy is second to none in quality, reliability, integrity, and excellence. There is no compromise on these values. Should you wish to register as a client or donor, please contact the following: Felina Management Consultants, 714 Francis Barrett Arcadia, 0083 Pretoria. Contact number +2771 543 2931. Email felina12@gmail.com. Play your part. Let's make Africa great, the Africa we want. My name is Nathan, and the topic for today is the lesson 2 of business transactions and supporting documents, a continuation of lesson 1, which we had previously. Please remember to subscribe, give the lecture a like, and note down your comments to enable us to continue rendering our services in a more effective manner. Let us start with the review of lesson 1, business transactions and supporting documents. The following were covered: further understanding of the double entry principle, various applications of the accounting equation, identification of the different types of business transactions and relating them to the accounting equation, and understanding of the perpetual inventory system. Relevant examples of each of the above were given to show how accounting applies in our day-to-day lives. Practice questions were given to enable everyone to follow the program systematically. The lecture ended with a call to all participants to engage in leadership in order to make accounting at all levels more meaningful and beneficial to society. Practice question 1 was saying that indicate how the following transactions affect equity, assets, and liabilities. The answer goes as follows. March 1, owner deposits 20,000 in the business bank account. This increases owner's equity and asset bank. And as you can see, the formula is saying O, standing for owner's equity, equals assets minus liabilities. Because it increases owner's equity, we have plus 20,000, and it also increases asset bank equals 20,000 minus 0 because the liabilities are not affected. March 2nd, purchases office equipment from company A for 40,000 on credit. This increases the asset of his equipment and also increases the liability, which is the company A. And therefore, if you put in our equation, you're going to say 0, because there is no effect on owner's equity, equals plus 4,000 minus a plus 4,000, because liabilities are also increasing. Mark 3, purchases a vehicle and pays cash 13,000. This increases the asset vehicle and also decreases the asset cash because he bought cash. There are two opposite legs of the asset. One is positive, one is negative. Of that, adding a vehicle, you're adding an asset. Buying cash, you're reducing the asset of cash. Still, the left-hand side equals the right-hand side. March 4, owner withdraws $300 for personal use. This reduces owner's equity and asset cash. By withdrawing, you're reducing owner's equity by minus 300, and you're also reducing cash of 300. March 5, sells one of his vehicles on credit to company B, 1,250. This reduces vehicle minus 1,250 and then increases debtor plus 1,250. Mark 6, obtains a long-term loan from the bank for 10,000. This increases the asset cash, increases the liability loan. You increase the asset by 10,000 and increase the liability by 10,000. So asset minus 10,000 minus 10,000 will give us 0. Mark 7, company B pays its debt of 1,250. This increases asset bank and decreases asset debtor. As you can see, 1,250 plus minus 1,250. Eighth, pays debt of 4,000 to company A. This decreases asset bank and decreases liability company A. In our equation, you're going to have minus 4,000 minus negative 4,000, which also becomes 0 because the minus and the minus turn into positive. So the lesson 1 practice question is shown in the table, as you can see, and practice question 2.2 says indicate how the following income and expense transactions affect the accounting equation. Match 1, buys cleaning material from company P on credit 1,000. Anything you buy reduces equity, so long as it's not a long-term asset. Buying cleaning material is an expense. Therefore, it reduces the owner's equity, and you are buying it on credit, it also increases the liability. So you are going to put in the equation 1,000 minus equals 0 minus 1,000, which gives us a minus 1,000 on the left-hand side and a minus 1,000 on the right-hand side. Match 2, pay allowances to personnel of 6,000. Decreases owner's equity and also decreases the asset bank by 6,000. Mark 3, receives 50,000 from Chu for services rendered. This increases owner's equity because it's a sale of a service and increases asset bank. 50,000 as owner's equity and asset as bank of 50,000. March 4, pay electricity bill of 4,000. This decreases equity and decreases asset bank because you are reducing the equity and you are also reducing the cash by paying. March 5, receives interest on investment from E of $8,000. This increases owner's equity because it is interest income and also increases the bank account because it is money that has been brought in as cash, not credit. And this summarizes into the table that we see right in front of us. Lesson 1, practice question in question 2.3. Using the perpetual inventory system, determine the effect of these transactions on the accounting equation. Buy inventory for cash, $1,800. This increases asset inventory and decreases asset bank. And then we have our equation. Asset inventory is 1,800 and bank is decreasing minus 1,800, which gives us 0. So the left-hand side is equal to right-hand side. 2, buy inventory on cash from our company, 1,250. This increases asset inventory and increase liability, which gives us 1,200 minus 1,200. 3, sell inventory for cash, 1,450, cost price 1,100. This one has the selling part and also the cost part. Under sales, it's going to increase equity and cash as our asset. So 1,450 equals plus 1,450 minus 0. Increase in cash and increase in equity. Then in terms of cost, it will decrease equity and reduce asset inventory. So we are going to have minus 1,100 equals minus 1,100 minus 0. Sell inventory on credit to S company for $1,700, cost price $1,350. On the side of sales, it is increasing owner's equity and also increasing cash. 4, sale of inventory on credit to S company for $1,700, cost $1,350. This increases owner's equity by $1,700 and also increases debtor $1,700. In terms of cost, it decreases owner's equity by $1,350 and asset inventory $1,350. 5, we return inventory to R company with a value of $880. This decreases the asset inventory of $880 and also decrease the liability of $880 because you had bought it credit and therefore it is reducing our liability. And the formula will give us a substitution of minus 880 minus negative 880, which is also equal to 0. 6, S company returns 1,500 worth of sales with a cost of 1,050. This reduces the owner's equity and increases the asset bank. It's a return inwards. So it means that everything that happens as a sale is reversed the same way. And therefore, you're going to have 1,500 as a reduction in equity and also 1,500 in reduction of the asset. S company returns 1,500 worth of sales with a cost 1,050. It's just a continuation. This increases the equity and increases the asset data. The equity is going to be 1,050 and the data 1,050. In summary, price practice question 2.3 is, as you can see in the table. Lesson 2, business transactions and supporting documents. Areas to be covered are calculation of profit, selling price, and cost price. Additional information on types of business transactions, how transactions are recorded, and source documents as the starting point of the recording process. As already explained, 2 double entries are required when selling inventory on the perpetual inventory system. In the coming studies on the accounting system or general ledger, we are going to be using the perpetual inventory system. On a number of transactions, given the selling price and the profit margin or markup, you will be required to calculate the cost in order to make the cost price entry. Example, XYZ company sold inventory for 10,000, a markup of 25% on cost price. This should be the approach in all questions. See what the entity is making profit on, in this case, the cost price. Complete the equation. Use the given information to calculate the amount you need. The answer goes as follows. In the above example, XYZ is making profit on the cost price. This increases the equity at either cash or debtors. And therefore, the table is going to be equity, which is plus 10,000, equals asset, which is 10,000, minus liability of 0. Then, the reference amount for which profit is calculated is given a value of 100. In this case, it is the cost. Profit is equal to 25, therefore the sales price is 125, which in this case is 10,000. Then cost of 10,000 times 100 over 125, which gives us 8,000. Therefore, the second equation will be a reduction in equity and cash, which is minus 8,000 equals minus 8,000 minus liabilities. If it was making 25% profit on selling price, then selling price would be given a value of 100. Then the cost would have a value of 100 minus 25, which is 75. Reminder, selling price minus profit gives you cost price. Profit is equal to 25. Therefore, the cost price is 10,000 times 75 over 100, which is 7,500. Therefore, the second equation will be a reduction in equity and cash, which is minus 7,500 equals minus 7,500 minus 0. Example 2. This one is a more simplified version of what you have seen before and makes your calculation much easier to understand. Making a profit of 25% on cost price and selling price of 14,000 cash. Step 1, cost price is 100. Profit is 25. And then selling price is going to be 125. Because you are being given the selling price of 14,000 and the value of 14,000 is attached to 125. Then step 2, use the table to determine what the given amount should represent. In step 1 above, 125 corresponds to the selling price of 14,000. So if you go to step 3, we are going to say, take the amount given, divide by the number it represents on the table, times the corresponding value of the amount you want. So in this case, we want cost price. We are going to say 14,000 divided by 125 times 100, giving us the cost price of 11,200. Now, what is the effect on the accounting equation? The first one relates to the selling price. Positive 14,000 equals 14,000 minus 0. Then on the side of cost, we are going to say minus 11,200 equals minus 11,200. In other words, the selling price increases equity and asset, and then the cost price decreases equity and also decreases asset. Example 3, making a profit of 15% on selling price and selling inventory for 2,000 cash. Because the question is talking about making a profit of 15% on selling price will be given 100, and the profit is 15. Then cost price is going to be 85. But the inventory was sold for cash 2,000. So 2,000 corresponds to 100. Second step is going to be use the table to determine what the given amount should represent in step 1 above. Like what I've already mentioned, 100 corresponds to the selling price of 2,000. Step 3, take the amount given, divide by the number it represents on the table, multiply by the corresponding value of the amount you want, which is now 2,000 divided by 100 times 85, which is the cost price. And our cost price becomes 1,700. The effect will be selling price equals plus 2,000 equals plus 2,000 minus 0. And then on the side of cost, it's going to be minus 1,700 equals minus 1,700 minus 0. So the selling price increases equity, the cost price reduces equity, and then example 4, making a profit of 20% on selling price and selling inventory with a cost of $5,000 cash. Step 1, cost price is 80, profit is 20. and selling price is 100. It means that because the cost 5,000 is the one that's going to be attacked to the value of 80. Then use the table to determine what the given amount should represent. In step 1 above, 80 corresponds to the cost price of $5,000. Step 3, take the amount given, divide by the number it represents on the table, then multiply by the corresponding value of the amount you want. And we need selling price. So you're going to say 50 over 80 times 100. If you wanted profit, we would have said 5,000 over 80 times 15. Selling price in this case is 6,250. The effect on the accounting equation: equity and asset cash will be increased. Cost and inventory will be reduced. Selling price is going to be 6,250 equals asset 6,250. Remember, everything was transacted on cash basis. Our equity is going to increase by 6,250, and the asset cash is going to be increased by 6,250. Then the cost is going to reduce by 5,000, and the inventory is also going to reduce by 5,000. Those are the examples. Now you are required to do practice questions during your free time. The first one says, the Fair Bread shop makes a profit of 30% on cost price. Their turnover in the second quarter was April 2023, 50,000, May 2023, 60,000, June 2023, 85,000. Required, calculate the cost and profit values for each month using the information that you saw in the examples. Practice question number 2. ABC company made a profit of 40,000 in year 2022. They anticipate an increase in profits of 15,000 this year. You are required to calculate the cost and selling price for each of these years. In 2022, their markup was 35% on selling price, and in 2023, it will be 45% on cost price. Calculate the cost and profit values for each month. Practice question number 3. Medi Limited makes a profit of 32% on cost price. Calculate the missing figures in the table below. There is a table which shows the cost price, 40,000, and then another one, a profit of 20,000, meaning that you have to calculate the cost price and the selling price. Then the one which is 80,000 selling price, meaning that you have to calculate the profit and the cost price. And then the one which is showing 20,000 profit, you will be required to calculate the cost price and the selling price. The last one is 35 selling price. You will be required to calculate the cost price. And if you want, you calculate the profit. Practice question number 4. P-Square uses the perpetual inventory system. It makes a profit of 20% on selling price. Calculate the missing figures in the table below. And there is a table, more or less the same as the previous question. We just need to slot in the percentages and the amounts. Let's go to 2.3, why are transactions recorded? To keep track of what is going on in the business. For instance, how much the entity must pay to each of its suppliers. Number 2, to get and keep useful information of how the business is using its money. In other words, where the money is coming from, what is it being used for, when is each debtor supposed to pay? For instance, calculation and payment of tax. How are transactions recorded? They are recorded in the business books of accounts known as the books of prime entry or journals and the general ledger. Transactions are first and foremost recorded on the source documents such as checks, invoices, deposit slips, credit notes, and so on. Then the business records each transaction systematically in the subsidiary journal in a date order. From the subsidiary journal, the transactions are recorded in the individual accounts in the general ledger. The general ledger consists of the statement of financial position, the statement of income or loss and other comprehensive income accounts are assets, liabilities, income, and expenses. The simplified process is as follows from what I've been explaining. You have a transaction that has taken place like sale of goods for cash. Then our source document will be the invoice and check or cash voucher, because you give an invoice when you are selling and the person pays. So one of them or both of them apply as such documents. Then the subsidiary journal would be the cash receipt journal, because you have sold. The ledger will be sales account. And then from the ledger, the information goes into the financial reports. And in this case, the statement of profit or loss and comprehensive income. Lastly, we need to know the impact of leadership on the recording of transactions. Let's take an example of a contractor supplying 1,000 cartons of paper to a government institution, for instance, a school. In a system where controls are weak, the storekeeper may connive with the supplier to receive 980 cartons instead. The papers were earmarked for distribution of 100 cartons to each of 10 schools. In other words, 1,000 cartons are going to be distributed to 10 schools, and each school is expected to get 100 cartons. Because of the conniving of the supplier with the storekeeper, 980 cartons were received, meaning that one school will receive 80 cartons instead. This may lead to the learners of this school go on a riot, destroy buildings because of poor service delivery. If the principal of the school does not complain because he belongs to the same party as the party in government, he will be held accountable. Yet the problem emanated from the collusion between the supplier and the storekeeper. The supplier was paid the full amount for the 1,000 cartons. Investigations and legal remedies may cost much more than the 20 cartons which are missing. This brings us to 3 reasons for recording transactions which apply in this scenario, being to track what is going on in the business and also to get useful information about the business. Absence of records would make it very difficult to investigate and take appropriate corrective action. The above example is tantamount to fraud and corruption, which must be fought head-on. Accountability plays a crucial role in addressing financial irregularities. How would this problem have been avoided? The accounting department would ensure that there was segregation or rotation of duties. In other words, it would be difficult for the storekeeper to connive because there is rotation of duties. The storekeeper or the supplier may not know who is in store on the date of delivery. On the delivery date, the department would have appointed someone else to receive the consignment, or count should have been done and signed off by someone senior, confirming that the quantities on the delivery note or ordered were exactly what was received. There would not be any loophole for collusion. In other words, there was a control weakness in the delivery process that the employee and supplier took advantage of. In conclusion, the following areas have been covered: calculation of profit, selling price and cost prices, use the markup on cost or margin on sales, as a percentage to arrive at the required amount. A sale increases owner's equity on the left-hand side, and an increase in either cash or debtor on the right-hand side. The corresponding cost reduces owner's equity on the left-hand side and a decrease in inventory on the right-hand side. Please remember this. Details of why and how the various types of business transactions are recorded are given. Source documents as the starting point of the recording process was explained with an example. Accountants play an important role in financial leadership. Politicians should depend on them to ensure efficient and effective service delivery. Accounting transactions should be always recorded using authentic supporting documents as evidence of the dates and amounts involved. Before we come to the end of this session, please note that in your comments, we also need your advice on the topics that you feel really crucial in your opinion, so that you can give them priority and preference in the next lecture or in our list of coverage topics. We want to ensure that no one is left behind. Let's work together to make Africa great, the Africa we want. This marks the end of our lecture. Please remember to subscribe, give the lecture a like, and note down your comments to enable us to continue rendering our services in a more effective manner. Thank you for your time. God bless you.